Everyone is talking about NVIDIA, but AMD stock is up 262% in the last year, and most investors aren't paying attention. The question is whether AMD can turn a blowout year into a long-term compounding story, or whether the market has already priced in the best-case scenario. I'm Edward Galstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down AMD through our 5 key factors: economic moat, returns on capital, growth, financial strength, and valuation. And at the end of this video, we're going to compare AMD directly to NVIDIA on valuation. You might be surprised which one looks like the better deal. Let's get into it. The moat is always our starting point, because if a company can't protect its profits from competition, everything else is irrelevant. Morningstar rates AMD a narrow moat, one step below NVIDIA's wide moat. Understanding why tells you everything about both companies. AMD's moat rests on 2 foundations. First, chip design and tangible assets built over decades. But more importantly, AMD holds one of only 2 x86 instruction set architecture licenses in existence. The other belongs to Intel. That license underpins the entire PC and server CPU market and cannot be replicated by new entrants. Qualcomm and Apple simply cannot build an x86 processor without one. Second is AMD's partnership with TSMC. While Intel stumbled on its internal manufacturing roadmap, AMD outsourced to the world's leading chip manufacturer and brought more competitive products to market faster, capturing meaningful share from Intel in both PC and server CPU as a result. That said, not all TSMC customers are equal. NVIDIA's explosive growth has made it TSMC's most valuable partner, securing the largest share of production capacity through massive upfront reservation fees, leaving AMD with a smaller slice. In a supply-constrained AI world, that difference matters. So why narrow and not wide? The answer is software. NVIDIA's CUDA platform has created deep switching costs in AI. AMD's equivalent, ROCm, is improving, but Morningstar is direct. Even if AMD's GPU hardware is competitive, the software tools are a hurdle where AMD is behind and needs to catch up. That gap is the difference between a narrow and a wide moat. Partnerships with OpenAI and Meta validate AMD as a genuine AI second source, but closing the software gap is the defining challenge ahead. Every data point in this video comes from Fiscal.ai, the platform I use for every stock analysis on this channel. Link in the description for 15% off. Returns on capital tell us how efficiently management converts investor dollars into real profits. Stay with me through this section. The growth numbers coming up next are where AMD's story really gets interesting. AMD's return on invested capital is 6.6%. I'm showing the chart from 2017 as 2016 was an extreme outlier. The trend shows a spike around 2020, a significant decline, and a slow recovery since 2023. The direction is improving. Compared to peers, NVIDIA is in a league of its own at 175.1% and accelerating. Broadcom is stable at 17.1%, Intel is recovering from minus 12.8% last year to 0% now, AMD at 6.6% is the weakest in the group today, but the trajectory matters. Same story on return on equity. AMD at 7.1%, slowly recovering, Broadcom is solid at 31%, Intel is recovering from minus 17.9% to 0%. NVIDIA is again exceptional at 119.2%. The returns picture is honestly not exceptional today, but the growth section will show you why that could change materially in the years ahead. Growth is the engine that drives long-term value creation. And this is where AMD's story gets more exciting. I'm showing the 10-year chart for transparency. Revenue has grown at a compounded annual growth rate of 26% over the last decade. I can't compute a net income CAGR due to negative earnings in 2016. So for a clean comparison, I'm using the last 5 years. Over the last 5 years, revenues have grown at a compounded annual growth rate of 20.5%, and net income of 7.8%. Revenue growth is strong, but earnings haven't kept pace. Earnings per share growth over the last 5 years is essentially flat at 1%, the weakest in the peer group. NVIDIA has grown earnings per share at 102.9%, Broadcom at 33.5%, and Intel is incalculable. But that's the historical picture. The short-term forward picture is very different. Analyst estimates show that AMD's earnings per share of $2.7 in 2025 will grow to $18 by 2028. That's a projected CAGR of 88.7%. Now what's driving this? First is agentic AI. AMD doubled its server CPU market forecast in just 6 months. The market is now projected to hit $120 billion by 2030. AI agents require server CPUs to orchestrate their workloads, and since enterprise data centers run on x86 architecture, AMD as one of only 2 x86 providers is uniquely positioned to capture that demand. Second is the OpenAI and Meta partnerships. Both secured deals for up to 6 gigawatts of AMD AI infrastructure each. To put that in perspective, NVIDIA estimates each gigawatt-sized data center represents a $50 billion opportunity. So the scale here is enormous, though not all of that flows to AMD directly. Morningstar models data center revenue growing from $16.6 billion in 2025 to over $100 billion by 2030. Now, is this future growth realistic? Morningstar is cautiously optimistic, but honest about the risk. The software gap versus NVIDIA is real, and execution on both partnerships needs to be flawless. That's a meaningful risk, and we'll come back to it in the valuation section. Financial strength is our sleep at night factor. Total cash and cash equivalents is $10.6 billion. Total debt is $3.8 billion. AMD can cover its entire debt with cash on hand. Free cash flow is $6.7 billion, giving a free cash flow to total debt ratio of 176.3%. where the minimum threshold is 10%. The balance sheet gives AMD the flexibility to keep investing in AI research and development and close the software gap. The valuation section is up next, and we're going to find out whether AMD is more attractive than NVIDIA right now. Even the greatest business can be a poor investment if you overpay. AMD's forward price to earnings is 51.8. In historical context, the minimum was 17.9, the median is 34.7, and the maximum was 65. AMD is trading well above its historical median. AMD at 51.8 is trading at a premium to both NVIDIA and Broadcom, two companies with stronger moats and stronger returns on capital. That premium looks difficult to justify. Now the price to earnings growth ratio, because PE alone ignores growth. The long-term analyst earnings per share growth estimate for AMD is 42.6%. Based on a forward PE of 51.8, that gives us a PEG ratio of 1.2. Below 1 is undervalued, between 1 and 1.5 is fair for quality, and above 1.5 is expensive. At 1.2, AMD is fairly valued on a long-term basis. Now here's the comparison you've been waiting for. NVIDIA's forward PEG is 0.65, deep in undervalued territory. NVIDIA has a wider moat, stronger software, better returns on capital, and is cheaper relative to its long-term growth rate. In my view, AMD is not a bad business. It's a good business at full price, with execution risk baked in. Now let's bring it all together through our 5 key factors. AMD is a narrow, not a wide moat, because of a software gap that separates it from NVIDIA. Returns on capital are weak at 6.6% return on invested capital, though in an improving trend. Future growth is compelling. An 88.7% projected earnings per share CAGR through 2028, driven by agentic AI and partnerships with Meta and OpenAI. Financial strength is solid, with a 176.3% free cash flow to total debt ratio. But at a forward PE of 51.8 and a PEG ratio of 1.2, AMD is fairly valued at best, and less attractive than NVIDIA, with a PEG ratio of 0.65 and a stronger moat. AMD could still perform well if execution is flawless. What do you think? Can AMD catch NVIDIA? Let me know in the comments.